If you own a rental property, you should know about the tax benefits provided by what is called a 1031 exchange. That is what we are going to cover in this video. A 1031 exchange is a tax-motivated process where you sell one real estate property and buy another. Intangible assets like shares of stock do not qualify. The property being sold and the new property being purchased must be like kind, which means the nature or character of the two properties are essentially the same. A 1031 exchange allows you to defer paying capital gains taxes that would otherwise be owed in the year you sell the property. This can be significant since real estate is often held for a long time, having appreciated considerably. The new property obtained takes on the tax characteristics of the initial property. As a result, no taxes are owed until the newly acquired property is eventually sold, assuming it isn't part of a subsequent 1031 exchange in the future. Before going further, given the tax-centric nature of this topic, I want to emphasize that we are not recommending that you or anyone perform a 1031 exchange. This is purely educational. We are of course happy to help you figure out if it may be wise, but regardless, we always recommend consulting your CPA before implementing tax decisions. Let's look at two examples. Say you plan to sell your rental townhouse and replace it with a condo on the beach that you also plan to rent out. This is a pretty typical 1031 exchange. The fact that you are technically swapping a townhouse for a condo is immaterial. Both are residential properties that are held and used for investment purposes. Now let's say you plan to sell your rental beach house and use the cash from the sale to invest in shares of stock. This would not qualify. Not only are they unlike, but the stock is not a real property. It is intangible and therefore disqualified on that merit alone. There are many rules to be aware of when doing a 1031 exchange, which we won't detail here. The biggest one being that it must be for business or investment purposes. You cannot personally use the property. To that end, understand the guidelines if you plan to convert a personally used residence into a rental. And lastly, from the time you sell the property, you have 6 months to take title of the new property, so don't milk it. Let's take a look at the tax impact of not doing a 1031 exchange before then looking at the benefits of doing one. Suppose you bought a property for $400,000. You treated it exclusively as a rental, and after 5 years you decide to sell it for $700,000. Without a 1031, you would owe capital gains taxes when you sell. The $300,000 you earned would be taxed as a long-term capital gain, since you held it for more than 1 year. For most, this tax rate is 15%, though it could be as high as 20%. The result is that you would owe $45,000 in taxes stemming from this sale, assuming no other capital gains or losses occurred during the year. Now let's suppose you don't need the proceeds from the sale of the rental home, so rather than pay the taxes, you would rather make use of a 1031 exchange and defer that tax payment. After selling the rental property for $700,000, you turn around and buy a replacement property for $800,000. You use the proceeds from the sale, plus an additional $100,000 of cash or debt, to make the purchase. By doing this, the taxes owed on the $300,000 gain are deferred into the future. The cost basis of the new property is now $500,000, which is the $400,000 basis from the first property, plus the additional $100,000 investment to buy the new property. Taxes are delayed until the replacement property is eventually sold, barring you don't delay them further by performing another 1031 exchange when that time comes. For more information about 1031 exchanges, or for other financial planning guidance, visit our website or contact us directly.